Investing can feel like guessing. Markets move fast. News breaks in seconds. Prices change in a blink. For many investors, this speed creates a constant, low-grade fear. They worry about missing out on the next big surge. They fear making a costly mistake fueled by emotion. They fear making a costly mistake fueled by a bad tip. They also hold back, paralyzed by indecision, and miss out on potential gains that could have secured their financial future. This is the core problem that has plagued market participants for generations. But today it's amplified by the sheer volume of information that bombards us every single moment of the trading day. This is the central dilemma. There is simply too much data for any single person, even a large team of human analysts, to process effectively. There is too little time to sift the noise and find the signal. People still rely on intuition, their gut feeling, to make critical financial decisions. While experience has its place, this method is dangerously outdated. In a world where algorithms trade in microseconds, a gut feeling is just a delayed reaction. So, what exactly is predictive analytics? At its core, it's a set of tools and statistical methods designed to forecast future outcomes. These tools leverage data mining, statistics, and machine learning. They analyze current and historical data. Inputs range from stock prices, trading volumes, economic reports, and corporate filings. The output isn't a guarantee. It's a calculated probability, a statistical edge, not a magic 8-ball. Think about modern weather forecasting. Satellites, weather balloons, ground sensors, all fed into complex computer models. They don't say it will rain. They give a probability, 70% chance of rain. Investors operate the same way, feed models with market data, sentiment, and fundamentals. The model outputs a score, the probability a stock will rise, fall, or stay flat. Old systems used simple rules like moving average crossovers. Predictive analytics goes far beyond that. It can spot that rising volume, plus positive social mentions, plus a slight commodity dip creates a high probability buy. This transforms investing from reactive to proactive. Scan thousands of assets for opportunities in minutes. Emotion out, discipline in. Systems run on data and logic, a steady hand in volatile markets. Shift the question. Not will it go up, but what's the probability it rises 2% next week? That's modern investing. Artificial intelligence gives modern predictive models their power and adaptability. Old systems were confined by fixed rules. AI learns directly from data. It discovers hidden, intricate connections. Models refine themselves without explicit instructions for every step. They handle big data, numeric and unstructured, from stock prices and earnings reports to text, audio, and satellite imagery. A model studies millions of price moves, headlines, and economic indicators, learning which signals precede rises or falls. Then it's tested on unseen data and deployed for real-time forecasts. Deep learning uses multi-layer neural networks, great for text and images. It reads thousands of articles and posts, classifies tone as positive, negative, or neutral, and outputs a score. That score becomes a powerful input to gauge market mood. AI learns nuance. Rate hikes can help bank stocks under certain conditions, like when inflation runs hot. Self-learning lets models evolve as markets change. That adaptability makes AI far more robust than static rule-based systems. The real revolution is in practical applications. Hedge funds already use these tools. A quant fund might run models that continuously scan social platforms and forums for sudden spikes in positive chatter. Spot the surge before mainstream news. Establish a position early. Ride the buying pressure. Exit into strength. Alternative data, like satellite imagery, is another edge. Count cars weekly and compare to history and expectations. Generate real-time foot traffic estimates. If counts run hot, odds favor beating sales expectations. Buy before earnings, capture the likely jump. AI can also act as a watchdog, monitoring thousands of names. It correlates dozens of factors per stock. Stock at all-time highs. But negative news grows. Short interest climbs. Suppliers guide lower. It aggregates the warnings into an elevated risk score. and prompts you to trim or hedge. Even long-term investors benefit. Screen the entire market for low PE, high ROE, dividend growth, low debt, in minutes. AI isn't a money printer, it's a tool. With risks and limits, predictions will be wrong. Models learn from the past. The past isn't always the future. Unprecedented events, pandemics, conflicts, disruptive tech, break patterns, overfitting, learning noise, not signal, looks great in training, fails live, combat it with rigorous out-of-sample testing. Data quality matters, inaccurate, incomplete, biased. Teams invest in cleansing, normalization, and validation. Tedious, essential. Transparency, the black box problem. Deep models are hard to explain. Investors need rationale. Regulators need fairness. Explainable AI helps, still a challenge. You must weigh predictive power against comfort and accountability. Sometimes simpler, more transparent models are the right call. How do you start out without a PhD? Start small, stay practical, build knowledge. Learn the basics. You don't need to code, but know the concepts. Get familiar with price data, fundamentals, and alternative data. Read about machine learning and sentiment analysis. This helps you ask the right questions and evaluate platforms. Set up a controlled test. Use paper trading or tiny real capital. Experience live volatility without big risk. Measure meticulously. Win rate, average gain versus loss, max drawdown, Sharpe ratio. Always test on out-of-sample data. Be honest. Only data proves an edge. AI is a co-pilot, not the pilot. Keep human oversight. Review choices, tune parameters, override when necessary. Markets are human. Intuition sees nuance models miss. Blend machine computation with human context. Never cede full control. Predictive analytics powered by AI is not a crystal ball. It's a powerful lens. It won't eliminate risk or guarantee profits. The future stays uncertain, but you'll see markets with more clarity. Analyze with superhuman speed. Make data and probability decisions, not guesses. Reduce emotion and chance. Speed matters, but use it strategically. Not everyone needs millisecond velocity. Screen global stocks, monitor macro risks, analyze earnings, call sentiment. This power adapts from seconds to decades. The promise, a more robust, intelligent process. Learn the basics, run small tests, keep a human hand on the wheel, spot opportunities, identify risks early. Stop guessing, start calculating. The market is getting faster and smarter. With the right tools, you can too. Subscribe for more insights, tap subscribe and the bell.